Accounting, also known as accountancy, is the measurement, processing, and communication of financial and non-financial information about economy. Manual accounting is to provide information about a business' wealth, financial position, and result of operations. Management accounting focuses on the measurement, analysis, reporting of information of internal use.
Journal and ledger. Journal is book of first or primer entry before posting to ledger are done. The journal is just like a diary whereby information such as the date, amounts, and other details regarding transaction is recorded. The books of primer entry consist of seven types of journals and petty cash book. The seven types of journal are as follows: is general journal, purchase journal, sales journal, return outward journal, and return inward journal, cash receipt journal, and cash payment journal. Net ledger. A ledger is a book, set of loose cards or files that contain accounts. The three types of ledger are the purchase ledger, sale ledger, and general ledger.
The trial balance is an important document for the auditor. The balance of the experiment is carried out to check that the sum of the debit and credit column of the general ledger account correspond to each other. This can help detect any accounting error. The trial balance is a accounting report that lists the ending balance is each general ledger account. The means that is take the total for each asset, liability, equity, renew, expensive, gain and loss account. The trial balance is run as part of the month and closing process.
The usefulness of the statement of profit and loss. The statement of profit and loss, also known as the income statement or statement of operation, is a financial statement that summarizes the revenues, expense, and resulting net profit or loss of a company over a specific period of time. It provides valuable information about a company's financial performance and is widely used by various stakeholders to assess the profitability and operating efficiency of the business. Here are some key reasons why the statement of profit and loss is useful. First and foremost, evaluating profitability. The primary purpose of the income statement is to determine whether a company has generated a profit or incurred a loss during a given period. It allows investors, shareholders, and potential investors to assess the financial viability and profitability of the business by comparing the revenue and expense figures. Stakeholders can gain insight into the company's ability to generate sustainable profit. Secondly, assessing financial performance. The income statement provides a comprehensive view of a company's financial performance over a specific period. It allows stakeholders to analyze the trend and pattern in revenue and expense, enabling them to make informed decisions. By comparing the income statement of different periods, stakeholders can identify fluctuation in profitability, measure the company growth rate, and assess the impact of specific event or strategy on financial performance. Next, supporting investment decision. Investor and credit often rely on the income statement to evaluate the financial health of a company before making investment decisions. It provides the information about the company's ability to generate consistent profit, manage expense, and sustain growth. By analysis, the profitability ratio derived from the income statement, such as gross profit margin, operating margin, and net profit margin. Investor can assess the company operational efficiency and compare it with industry peers. Then, facilitating financial planning and budgeting. The income statement serves as a critical tool for financial planning and budgeting purpose. It helps business project fixture review, estimate expense, and forecast net profit or loss. By analyzing by analyzing historical income statement, company and can identify cost-saving opportunities, optimize revenue stream, and set realistic financial goals. The income statement provides a benchmark against which actually performance can be compared, allowing company to make necessary adjustments to their financial plans. Last point is meeting regulatory and legal requirement. The income statement is mandatory financial statement that business must prepare and disclose to comply with accounting standard and legal requirement in ensure transparency and accountability by providing an overview of a company financial performance to regulatory bodies, tax authorities and other stakeholders. The income statement along with other financial statements from the basic for tax calculation, financial reporting and auditing purpose. Overall, the statement of profit and loss is a vital financial statement that offers insight into a company's profitability, financial performance, and viability. It is a fundamental tool for decision making, financial analysis, and meeting legal requirements, allowing stakeholders to assess the financial health of a business and making informed judgment.
The usefulness of the balance sheet statement. The balance sheet is a basic financial statement that provides an overview of a company's financial position at a particular point in time. It presents a summary of a company assets, liabilities, and shareholder equity, and it is useful for several reasons. 1. Assessment of financial position. The balance sheet helps assess the financial health and stability of a company. By analyzing the composition and value of its assets and liabilities, stakeholders can assess the company's ability to meet its financial obligation, its liquidity, and its solvency. 2. Decision making. The balance sheet is an important tool for decision making. Inventory creditors and analysis as is to assess a company financial strength before making investment decision or extending credit. 3. Performer evaluation. Compare balance sheet from different periods allows stakeholder to analyze the company perform over time. 4. Creditworthiness assessment. Leader and creditors rely on the balance sheet to assess a company creditworthiness. By analyzing a company assets, liability, and debit structure, it can assess its ability to repay loan or make cultural obligation. 5. Investment analysis. The balance sheet provides important information for its investment analysis. Inventor can ask it to assess the interest value of a company's stock, analysis its capital structure, and calculate key financial ratios. 6. Regulatory compliance. Balance sheets are important for regulatory and legal purposes. Companies are often required to prepare and present balance sheet in accordance with account standard and regulatory guidelines. The balance sheet is a vital vision statement that serves as a foundation for assessing company financial position, making informed decision, evaluating performance, and complying with financial regulation. Its usefulness extends to various stockholders, including inventors, creditors, and analysis management and regulatory bodies.
In conclusion, accounting is a systematic way to report financial transactions in business The main purpose of accounting is to systematically record financial transactions in the book of accounts and to know the profitability or loss and financial stability of the business. Learning the basics of accounting is very important for a person to know to some extent about the fundamentals that underlie this knowledge. Indirectly, it is important to learn the basics of accounting for doing business because it has many benefits such as being able to compile financial record, being able to assess financial performance, simplify the planning process, assess the capabilities of the business, and being able to control the debts or losses faced in the business. Therefore, to make sure a solid management and financial system, we need to be capable in using the accounting system properly in business management. This will help us not only in the short term but also enable in the long term smoothly.